Well, hi, it's Chris Saunders here from Capital Counts. Welcome to another Meet the Fund Manager investment series. Today I'm in Magellan Financial Group's head office here in Sydney. They've got offices in Sydney, New Zealand and the US. Chris Weldon, one of the portfolio managers here for the Global Fund and also the High Conviction Fund, very well versed to talk to us today about all things Magellan. Magellan was established back in 2006 by Hamish Douglass and Chris Mackay. They manage over $92 billion. And again, very, very excited to listen to you guys today. Can you tell us a little bit about the Magellan Global Fund?
Sure, thanks for having us, Chris. The Global Fund kicked off back in June 2007, so we've got about a 12-year track record now with the Global Fund. What we're trying to do is two things with the Global Fund. Always been the same two objectives. The first is delivering absolute returns of 9% after fees or better through the cycle, so over the medium to long term. And the second objective, equally important, is around capital preservation, providing downside protection to clients in the fund. And over that 12-year period, we've had about 12.5% after fee annualised returns. And on that second objective, the capital preservation, one of the ways we measure that is through something we call downside capture, effectively how the portfolio has performed during periods of market stress, so when markets are declining. And the downside capture for the Global Fund has been about 0.5. So we're falling about half the extent of markets during periods of market stress and delivering high absolute returns over that 12-year period of the fund.
Can you tell us a little bit about your investment process and perhaps your point of difference to the other fund managers out there?
Sure, there's three areas, three legs to the stool that we say for our investment process. The first is very deep fundamental research on a universe of very high quality companies. And that's, I think, probably the first and arguably maybe the most important area of differentiation is we restrict our universe to very, very high quality businesses around the world. And we do an incredible amount of research on those companies, so very deep understanding of the companies, the industries and their prospects, deep fundamental research. So that would be one area of our process. The second is applying a macroeconomic overlay on top of that. And that's really around trying to identify risks to the portfolio posed by the macroeconomic environment, but also the occasional opportunity that can be presented by the environment as well. If we think back to our investments in Lowe's and Home Depot many years ago, that was the perfect marriage of the bottom-up research in some very high-quality home improvement retailers over in the United States, but also recognising how those businesses would benefit from a housing cycle and an economic cycle over in the US. So that's where you can see both the first and second pillars of the process working together. But that second part of the process, macroeconomic overlay, is really around event risk mitigation to the portfolio. And the third and final part of the process really is around our risk disciplines and portfolio construction at Magellan. So we run benchmark agnostic portfolios. We don't look anything like markets. They're very concentrated portfolios. The Global Fund runs between 20 and 40 positions, typically holds about 25 positions at any point in time. We have a willingness to dial up cash from time to time, which others may not have that ability or willingness to do so. We can hold up to 20% cash in the Global Fund. And we apply a risk budget or risk constraint to the overall portfolio. We cap effectively the Global Fund portfolio risk relative to markets at about 0.8 of the market risk overall. So we always have a very strict risk constraint and risk discipline in the portfolio. And I think that's quite different from some other managers as well.
The last 12 months, obviously, we've seen a fair bit of volatility increase. So what are you putting that down to and where to from here?
Yeah, it's an interesting question because arguably part of it is just volatility has returned after a very lengthy period with abnormally low volatility in markets. After the financial crisis around the world, central banks really stepped in and through quantitative easing programs and a series of other interventions really suppressed volatility for a long period of time. But of course that's changed over the last 12 months or so. And probably the two big factors we'd suggest for that return to volatility, the first one relates to monetary policy and the fact that yields around the world have moved to very low levels We have low single-digit yields in many developed markets, zero yields, negative long-term yields. That changes your view on the value of all assets, including equity. So that will cause some volatility in equity prices. And the second key driver of that volatility, we think, is what's going on between the two largest economies on the planet, between US and China, and this recent trade and geopolitical tussle that those two large, meaningful economies are involved in at the moment. And we would expect that to probably continue for the short term and even for the long term as well. But certainly in the short term, you've got an election cycle coming up, and Trump has been very forceful in his rhetoric and some of his actions against China. So that could continue as we get closer to the next election.
Markets appear to be quite expensive right now. Our clients are speaking to us and saying, well, look, is it a good time to come in? Prices are elevated across the globe. Should we be taking profit? If we've got new money, should we drip feeding the funds back into the market slowly? Have you got some comments around that?
Yeah, the initial comment would be we don't know where markets are going in the short term. We don't think anyone does either. So some caution is warranted there. In terms of whether or not markets are expensive overall, really comes back to that point around where you think long-term yields will settle going forward. Because if we are in this lower for longer yield environment, you could argue certain equities, not all equities, but certain equities are probably still quite undervalued. And therefore, some equity markets could still be fair value or undervalued around the world. But if you're of the view that long-term rates are moving to a higher level, some sort of historic level, then equities look more fairly to overvalued in our mind at the moment. As we relate it back to what we do on behalf of clients, we don't own markets, of course. We have a 20 to 40 stock global fund, which looks nothing like markets. It's a very concentrated portfolio. And even our universe is only a couple of hundred high quality businesses around the world. And as we look at that universe of high quality businesses, we're still seeing some very healthy levels of margin of safety. What we think a company's worth compared to the share price today, there is still a healthy margin of safety across our portfolio and the broader universe as well. But that doesn't look like markets. We should be quite clear that our universe is not the same as what markets look like around the world.
I've seen significant changes perhaps in the portfolio. What have you been doing there, and how are you positioned the portfolio now?
Yeah, we have had a lot of change in the portfolio over the last, let's call it year to date, 2019. And what we've been doing there is taking some of the cyclical risk out of the portfolio and adding defensiveness to the global fund. So if you wind the clock back to end of 2018, we were sitting at about 20% cash in the global fund, and that's today around 7 or 8%. So quite a meaningful change in the cash allocation in the portfolio. As I mentioned, most of that has gone into some very high quality defensive businesses. We have a couple of new utility positions, very high quality, regulated monopoly, but very defensive, predictable businesses. We've added some consumer staple names, businesses like PepsiCo, which has a very dominant snacking and chips franchise around the world. And then positions in the two largest brewers on the planet, AB, InBev and Heineken. And brewing's an industry that we really like. Very consolidated, high margin, high return, and defensive industry. Then what else across the portfolio? We've actually been adding to some Chinese consumer opportunities as well. So 3 new positions there. Estee Lauder, LVMH, and Alibaba are 3 new positions in the global fund. And they, in their own way, are really playing to the long-term consumption opportunity that exists in China, really across the middle class, which Alibaba plays to, so does Starbucks, incidentally, which we've held for a number of years. Then you have businesses like Estee and LVMH that play more to the upper class and affluent class consumption opportunity in China, which is actually where we're seeing the highest levels of growth in China today. So they're sort of the broad changes of the portfolio over the last six or so months.
The fund itself is renowned for stock picking. You've mentioned utilities and brewing and obviously consumption out of China. Are there some stock stories, thematics perhaps that you're looking at that you'd like to share with some of my clients?
Yeah, I think that Chinese consumption opportunity is incredibly attractive. And for a number of reasons. I mean, first of all, it's an enormous market. You've got 1.4 billion people there in China today, so it's a huge market. And then you have these parts of the economic pyramid that are demonstrating very high levels of growth. So it's expected the middle class in China could double over the next 5 years or so. That's adding another 300 million people to the Chinese middle class. That's the entire US population being added in the next short to medium term. The upper class in China is expected to grow by 4 times, from about 50 million to 200 million, so huge growth there. And then that affluent part of the pyramid is expected to grow 6 times, from about 10 million consumers to about 60 million consumers. So in this very low growth, low yield world, that is very attractive growth, and it will support the enduring growth of businesses like Alibaba, which has 70% market share of all e-commerce in China. Some of the numbers around Alibaba are breathtaking. There's about just under 800 million users that Alibaba has. That's over half of the Chinese population. It's more than 10% of humanity on Alibaba's platforms today. And that business will stand to benefit from the growth in consumption, the growth in e-commerce in China, the growth in digital advertising in China. It also has the largest cloud computing business in China, 3 times the size of its nearest competitor, has a very large food delivery business, logistics business, the largest or a key shareholding in the largest financial payments business in China. So everywhere that China is expected to go, the Chinese economy over the coming decades, Alibaba is incredibly well positioned to benefit from that growth over the years and decades to come.
Thank you. And I'll put you on the spot. You've got a spare dollar today.
Yeah.
Where do you put it?
That comes down to each individual's risk profile. Yeah. Look, Alibaba is an incredibly attractive business, we think. It's incredibly high quality, for reasons mentioned, very dominant in each of the different businesses and industries that it participates in. We also think it's meaningfully undervalued at the moment. And if you kind of just strip the valuation of Alibaba back, just to focus on what the market is pricing that core e-commerce piece, 70% market share, it's growing its total sales value on the platform over 30%, will continue to grow at very healthy levels, earns margins near 70%, so incredibly high return, highly profitable, high growth business, very dominant. We think the market is pricing that at about 18 times forward earnings, which is only a touch above where the S&P 500 is trading at the moment. But the S&P does not offer you that quality and that growth compared to something like Alibaba. That will not be a business for everyone's portfolio though. But we think within a well-constructed portfolio like the Global Fund, where you can have positions like Alibaba, balanced with some businesses like very defensive utilities, it certainly plays a nice role in that portfolio.
Well, thanks, Chris.
Thank you, Chris.
Really appreciate that. Again, I'd like to thank Magellan for hosting today. It was a great session. As always, please call us on 1300 882 166 for any questions you might have around your financial circumstances, any changes, or clearly if you want some more information about Magellan. Thank you very much.